Own a home and need cash? While it isn't always wise to tap into your home's equity just because you can, equity can be a valuable resource when you need cash for a justifiable reason. In this video, I'm going to talk about the three primary ways to turn your home's equity into much needed cash. But first, let me introduce myself. My name is Jeremy Stebbins, and I am the senior mortgage broker with the Mortgage 101 team. My team specializes in residential mortgage origination, as well as making home ownership education better and more accessible for everyone. Now, before I jump into the three main methods for turning equity into cash, let me just say this. Just like it is probably better to not plunder your savings accounts unless you have to, it is probably best to not tap into your home's equity unless you have to. If you're in a position where you need cash for an emergency, a big family development, or even a new investment or business venture, tapping into your home's equity might be a terrific option. Now, keep in mind the amount of cash you can take out isn't limitless no matter what option you choose. In fact, most banks will not lend you any money above 80% of your home's value, and that is including any existing mortgage on the property already. So to make that more clear, you likely need to have well over 20% in equity in your home to even explore any of these options, and probably even more equity if it is an investment property instead of a primary. I'm also not covering shared equity agreements or other less proven or possibly sketchy contract agreements you could make with private investors, which would involve trading a percentage of your home's future equity for cash now. That might be a plausible option, but you'll have to find another source if that is something that you're interested in. Okay, ranking in at number 3. The first option to tap into your home's equity is a cash out refinance. This means you are completely replacing the existing mortgage on your current home with a new mortgage. That means if you used to have a low rate on your prior mortgage, a cash out refi would wipe out that rate completely and you'll be subject to the new rate. If you currently have a lower rate on your existing mortgage, a cash out refinance should probably be viewed as a last resort, since a cash out refi in today's market could seriously increase your monthly payment and could easily double the interest you pay over time. Now, keep in mind, there is a time and place for a cash out refinance. Refinancing your home will almost always offer better terms than, let's say, a personal loan or a business loan. It also might be a great vehicle for debt consolidation, depending on the situation. Using your home as a collateral, even in a cash out refi, allows the bank to offer you a better rate than getting an uncollateralized loan somewhere else. But because a cash out refinance in today's market poses more financial risk as well as more limiting than some of the other options on this list, it is still squarely ranks number 3. Okay, ranking in at number 2, we have a HE loan or home equity. What if you could keep your lower interest rate on your main mortgage and get a second mortgage offered at a fixed and predictable payment? A HE loan does just that. It allows you to carefully carve out a premeditated amount of equity you think you need and not a dollar more, and have predictable terms on paying that second mortgage back over time. You might consider pulling out a little bit more than you think you need, because unless you completely refinance that second mortgage or HE loan in the future, you'll have a very hard time accessing more equity above and beyond that cash out. The HE loan is a great tool for someone who wants to consolidate debt and limit their interest exposure over time. But ultimately, because a HE loan still lacks flexibility, it gets my number 2 ranking. Finally, ranking in at number 1, I'd argue that we have one of the greatest leverage instruments ever made, introducing the HELOC, or home equity line of credit. A HELOC earns our number 1 ranking because it is the one mortgage option that can offer you greater financial security without ever spending a dollar in interest. A HELOC is not a loan, it is a line of credit for a predetermined amount by the bank that you only tap into if you need to. Let's say the bank agrees to offer you $50,000 HELOC for 10 years. If you do ever have to tap into those HELOC funds, you would have to make interest-only payments based on the balance you took out. But if you don't ever tap into the equity, you essentially added $50,000 in emergency funds to your nest egg without having to slowly save that money over time. A HELOC is a great tool, particularly for someone who might be starting a new business venture or is heading into a time of financial uncertainty. HELOCs are not the best instrument for paying less interest over time. In fact, they even have variable interest rates that might fluctuate. But they make up for it in flexibility and potentially giving you and your family more emergency funds that you only pay interest on if you use those funds. And you can always pay a HELOC balance back and replenish that line of credit at any time. Eventually, typically after 5 to 10 years, a HELOC will mature past its withdrawal period and enter into a repayment period. So you'd want to understand what the terms of the repayment period are. Before tapping into your home's equity, remember to ask yourself if it is really necessary or if there are better options out there. But if you do tap into your home equity, make sure you select the debt instrument that makes the most sense for you and your situation. I'll wrap it up from there. Again, my name is Jeremy Stebbins with the Mortgage 101 team, and I hope that I have invested in your home ownership journey through this video. If I earned it, please hit the like button. Thanks.